Hey guys, happy Saturday, coming to you from the home office. I am with Barry the dog. He is my trusted assistant and he's hard at work. So today Barry and I are talking about self-employed buyers and how to write off things on your taxes and still qualify for a mortgage. I've had 3 different real estate agents come to me in the past week that have all asked me the same question. They said, Alex, it's tax time. I want to file my taxes. I'm going to file my taxes, but I can't do that and still qualify for a home. What do I do? How do I write things off that jives with getting a home? And so, I want to come to you with 3 things that every real estate agent out there can use. And really this applies to any 1099 employee. If you're an independent contractor, if you're an owner-operator, realtor, 1099, whatever, it'll fit that mold. 3 things that you can absolutely write off on your taxes that will help save you some tax money, but that won't impact you negatively when it comes time to qualifying for a home. And the first one is mileage, especially if you're a real estate agent. You guys drive all the time. You're in, it's just crazy. I don't envy you at all. So you got to write off your mileage, because mileage is a great tax deduction, but it's also a non-cash expense, which means that we can add it back into your cash flow. So let's say that you drove 20,000 miles last year, all right? We can add back in 25 cents per mile that you drove on your Schedule C. So if you drove 20,000 miles last year, well, that's $5,000 worth of income that we can then put back into your cash flow. All right, so mileage is a huge benefit. Definitely write off your mileage. Depreciation is the second one. If you have a vehicle that you use for work, whether you're that same real estate agent that's driving around Houston, if you have a truck that you use for work, a work truck, really any scenario in which you have a vehicle that you use for business purposes, you can write depreciation off on your taxes. Depreciation is another non-cash expense. We can add it back to your cash flow. So if you had $5,000 worth of depreciation on your vehicle last year, that's $5,000 of income that can be added back to your cash flow. You can write it off, but it doesn't hurt you when it comes to qualifying for a mortgage. And the third example is home office use. It's line 30 on your Schedule C. Not a lot of people use it, and you do have to be careful. I will caution, talk to your CPA or your accountant how to calculate that, because there are rules that you need to follow. But if you use your home if you use your home as an office space for your business, then there are certain limits that you can write off on your taxes that'll give you a good deduction, but they don't hurt you with your mortgage, because again, it's a non-cash expense. It can be added right back into your cash flow. So in closing, all 3 of those things, let's say you're a real estate agent that drove 20,000 miles last year and you had $5,000 of depreciation. Lost you. 20,000 miles last year, $5,000 in depreciation, and $1,000 in home office use. Well, that's $11,000 that you can write off that can be added back in. So let's say you made 50 grand last year. You wrote off that 11,000, so you're only paying taxes excuse me, on 39, but you're getting credit for 50 on paper because we can add it back to your cash flow. So that's all I got. A couple little tricks to kind of take full advantage of the tax system as far as being able to legally file your taxes and for mortgage purposes, maintain qualification on a home. If you have any questions about more detail, we could talk all day. Barry and I will be here. Give us a call. Bye.